Welcome to another episode of Market Matters. My name is Kumar Panja and I run the EMEA Capital Advisory Group here at JP Morgan. I'm joined today by Amy Flikerski, a Managing Director and Head of the External Portfolio Management Group at CPP IB. Welcome, Amy.
Thanks, Kumar. Great to be with you.
Great to see you again. So what we thought we would talk about today, kind of three things, and we're going to interweave, lace them through the conversation today. The first thing we'll talk about are questions that hedge fund managers have, whether it's aspiring hedge fund managers, whether it's established hedge fund managers, and the questions they have and they ask us about how to approach CPP investments, things like team structure, things they should be doing, how they should engage. The second thing is, certainly from our perspective, CPP Investments is held up as a model for some other investors, for long-term investing in particular. And I think it'd be useful if you could share some insights into how you've done that and what is the model going forward. And then we'll also, of course, touch on current themes of the day. And as I say, we'll mix it up in what we talk about. But for those hedge fund manager listeners who are not aware of CPPIB's impact in the hedge fund space, not quite sure what stone you've been under, but I direct you to their website, which has a lot of good information, and unusually so because it's very, one of the things we'll talk about is the transparency that you provide. But if any of you want to know more about CPP Investments, before you speak to them, please do call me or anyone on the team, and we'll have it to talk through before you engage with CPP. I think, Amy, it would be useful to talk about your specific role within external portfolio management.
Happy to do that. Thanks, Kumar. So I lead the External Portfolio Management Group. We're a global team. We manage a fair bit of capital focused on just public market external managers. We are based in Toronto as a firm, but we are global as a group, and we have a global footprint as a result as well. So we're Toronto, London, Hong Kong, New York. We're about 40 people. And my role is to lead this team. And what we do is investments in established managers, emerging managers, as well as public market co-investment opportunities through managers. So it's a broad-based program. And then we also have portfolio construction and risk within the team as well.
Right. And you talked about, the stripes in the team just a moment ago. Certainly one of the questions that we get is about the team structure. Is there, an entry point or several points that you would suggest to managers when they come into CPP? How is the team structured?
In terms of how we're set up, we have sub-strategy specialists. So we have senior team members who are the point people for those strategies. And as I mentioned, it's really broad in terms of the coverage from the commodity, insurance link to more scalable areas like fundamental equities. But basically, the approach would be through either JP Morgan Cap Intro or through our team directly. We're one team, so it's quite flat. If any inbounds come either to me or to other colleagues, we figure out how to direct them appropriately. But in terms of kind of fleshing out the structure, we've got roughly those 6 to 8 strategy leads, myself, and then we have a number of mid and junior colleagues who are supporting us, and that makes up the 40 people across the different geographies.
Very good. Just looking back now for kind of the last 3 or 4 years and the current investing environment, it seems quite positive. I mean, you and I were talking about one of the charts that my colleague here, long-term strategist Jan Lois, uses to show hedge fund excess returns over the last 25 years. And the listeners can't see the chart. Of course, we don't have that facility here, but Amy and I have looked at the chart, and what it shows is those excess returns were there kind of up to about sort of 2006, and then went into kind of flat to negative territory and has come back up, not to the same levels as certainly in the late 90s, early 2000s, but has certainly come back up. So all of that sort of paints the picture that I think most of our listeners are aware of by now, that it's a good environment to be investing in hedge funds. It's a good time to be a skilled hedge fund manager deploying their skills into the marketplace. How have the last 3 years looked for CPP? I mean, what's performance been like?
The last 3 years have been really strong, particularly 2022, I think, when broader markets, both bond and equities, were down and there was a correction in tech. I think we were able to demonstrate through our hedge fund program, which is very diversified and global, that we could generate returns even in amidst a market backdrop and really show the benefit of decorrelated nature or uncorrelated nature of hedge funds in that kind of period. So I think that is a really good testimony to the value of hedge funds and having the diversification and having that exposure in portfolios.
And does that mean that the view on the current environment is positive so that you are continuing to deploy money?
Absolutely. The chart that you reference is compelling, and I think we do see that in terms of pull forward of returns through hedge funds. It's been a strong 2024, and I think that investors broadly have seen the benefit, of course, of having the public markets exposure, the ability to have more flexibility in capital deployment through public market hedge fund managers, the ability to access parts of the market like macro or credit or systematic, which are complementary to whatever private equity or venture or even private credit that they may have in their portfolio. So I think it's a great opportunity set as we continue to see evolution in the market. We just had the US election, of course, and we'll continue to see what happens. But it's a great backdrop in terms of potentially, more deal making, more confidence, more activity, which could translate to better opportunity set across different strategies.
Yeah. I mean, on that point, I think this kind of the mid to longer term environment, which we just touched on, I think it's been observed that the combination of the kind of the macroeconomic backdrop of elevated fiscal spending, political uncertainty around the world, higher rates, and just greater macro vol in particular provides the environment for hedge funds to do what they're supposed to do, and therefore improved hedge fund returns. Do you think that applies to all sectors in the hedge fund space, or do you think there are some that are naturally poised to perform better in that type of backdrop?
I think it's tough to call the alpha in a given strategy. So we tend to think of it as hard to time strategies. So we have roughly a band of allocation across our different areas, and the diversification in the way they all fit together is really kind of the special sauce, exactly,
Yes.
if you will, if one wants to call it that. I think that's where it all comes into play, the complementary nature of macro, of fundamental and systematic kind of coming together. So it's always going to ebb and flow in terms of what you've described, but we think the breadth of our program enables us to deliver on that alpha opportunity set.
And you're known to be an investor with a large portfolio and therefore making kind of large investments. But what about niche strategies? Are they still of interest?
So we have a large program, as you mentioned at the start, of a very large investor in hedge funds globally. With the seeding, I think we're quite known for that. But we do a lot of different types of investments, both large and early stage. And sometimes they are niche opportunities that are not emerging managers. They can be in nascent markets like carbon trading or specialty sector funds. So we do target that in terms of the potential for higher return profile. Scale and capacity is important to us, but we also think there's a role to play of more niche strategies within our portfolio. For example, fixed income relative value has been an important bedrock of the program as well, and we may have an approach where we'll invest in more managers where it's capacity constrained to kind of get the aggregate asset allocation that we're looking for.
And one of the topics that we've had from investors, particularly sort of North American pension groups, but not exclusively, has been an increasing reinterest in portable alpha, which, it's a concept that we know has been around for years, cost-effective way to effectively increase returns on public equity portfolio by building in alpha from long-only, on the long-only side, to complement equity beta. What's your view on that?
Sure. I think that it sounds that the evolution of portable alpha has evolved since its initial beginnings in the 2000s. It sounds to me that it's a big area of interest from a lot of different pools of capital. For CPP Investments, we're trying to deliver alpha for our organization. And so we effectively act in a portable alpha type of nature where we're complementing our private equity.
The alpha stripe.
Exactly.
Yep.
We're the alpha piece. And there's another department that is doing that as well, which is called active equities, but that's effectively what we're trying to do. So it makes a lot of sense for those who are really trying to allocate fee dollars for something that's unique and special above what they can access more cheaply through passive exposure.
Yeah. Okay. If we pivot now to questions that managers often pose to us when they ask about CPP investments and say, how do we go about getting in touch. And there's a bunch of questions that they ask us. One of the questions, and I think you mentioned it earlier, in terms of timing, they want to give it their best shot, and equally they don't want to waste your time. There's a tension there. What advice would you give to managers, new managers, that are thinking about approaching you?
Sure. So my colleague Jan Kvitko leads our emerging managers program, which is, as I mentioned, part of our team. We're one team. So Jan does like to meet folks early, even before they may have materials or a fund, if they're just thinking about it. I think that's part of really what it is. It's a dialogue between us and the managers. And I'm sure, Kumar, your team is doing the same thing. And we often also get, I think, introductions through your group in that sense.
But they shouldn't fret too much about the time.
Exactly. I think sometimes those early discussions can help shape how a manager wants to launch as well. Certainly, we're not trying to have a hands-on approach. We don't have that approach in terms of our investment, but it can help inform choice of providers or operational best practices, et cetera, or fee alignment, for example, as well. So I think there definitely should not be consternation around early conversations. And it's, again, part of the process is to have evolving dialogue.
Yeah, no, that's good. The other thing that comes up a lot is the track record, and the managers sort of put themselves under a certain amount of pressure to make sure that they can show and they can come to that meeting, that first meeting or early meetings with a demonstrable track record. But of course, we both know that sometimes structurally there isn't the ability for an individual to have a track record that is attributed to that person, either because they've been working for a single CIO type hedge fund where the contribution of that particular portfolio manager can't be stripped out as easily, or the other construct is where they've been working perhaps in a multi-manager setup where, again, there might be contractual restrictions about pulling out the data. But how do you think about that? What are your tips on managers preparing to show their contribution in that construct?
Yeah, that's a fantastic question. So we've been creative around that. Not all investors are the same. So for us, we don't need a minimum years of track. We have often actually invested even with no track, as you say, Kumar, no verified track. So what we do is we triangulate. So we say, because of our participation in the markets, we'll often know the firm where they're coming from, so we can triangulate through both provided and off-list referencing to triangulate into the individual's contribution from a performance viewpoint. And again, not looking to the dollar, but to a general high-level sense. We also look at compensation to cross-reference what the individual has shared in terms of their P&L impact. So we'll look at tax statements and things of that nature. So yeah, it's a triangulation process in which we'll look at many different pieces of information, but largely trying to pull together the mosaic of data that we might be able to come across. But it all starts with the first conversation with the individual.
Of course, but it sounds very accommodating, as you say. And the last point, because this isn't supposed to be a talk just about new managers, but a lot of managers will come to us and ask, seed or not to seed. And, CPPI is associated with being very active in the hedge fund seeding marketplace. But, is that something which managers need to get their heads around, or will you have relationships with new managers, both with a seeding relationship and without?
So we kicked off formally our emerging manager program back in 2016. We had done some seeds before that, but we officialized the program with certain beliefs and approaches. And what we do through early stage managers is both seeding and capital acceleration. So seeding would be the day zero investment, the cornerstone anchor into a new launch. And we'll often actually negotiate for revenue sharing in that case to mitigate the downside risk that we're taking at that early stage. In addition to seeding, we also do what's called capital acceleration, where we're investing in a fund that may be 2, 3, or 4 years old or more, but seeking those kind of more founders-like fees. And in that case, there's no revenue share. And we're not incentivized so much around revenue share. It's more, again, the downside protection to going early. We are very focused on performance and return. So that really is what's driving our interest on the rev share side. And then more broadly, why we do early stages to be able to access the capacity, future capacity as well, and to be able to kind of negotiate commercial terms that make sense for us. So I think it's something that we're known for, and we are utilizing our long-term horizon as well as our stable capital to be able to participate in that way in the market.
In terms of established managers, then, so again, we talked about this earlier, your website is wonderfully transparent in terms of some of the relationships you have with external portfolio managers. But the question sometimes comes to us from managers who've been, running a business for several years, if not, a decade or so, that is there an opportunity for them to engage with you if, for example, there might be another manager that does something that's similar, or maybe it's in a similar segment? What are the rules of the road for established managers? Do they differ vastly from what you've just talked about in terms of new managers?
So we run one portfolio. So that's the beauty of having kind of a simple approach. We think about the portfolio in aggregate. We don't kind of think about it as the emerging manager portfolio and then the established. It's all one. And then one important point actually to add, if I may, to the emerging piece is we're evergreen investors. We don't have, a pool of 3-year capital that we need to then recycle. So if that emerging manager does well, they, quote unquote, graduate into our core program. And again, it's the same pool of capital, but there's a view that we don't have to ever redeem because it's going well, it's meeting our objectives, and they're no longer tagged as emerging.
And you recently launched another program, didn't you, to sort of capture even sort of smaller managers?
That's right, exactly. So Kumar, you're referencing what we call Inicio. So that's our answer to the SMA platform. And the motivation for that, it's still in kind of early stages, but the motivation has been to be able to perhaps write smaller tickets to access an even wider breadth of managers, back to the niche point, to enable additional diversification to what we have. And again, to see what success can come through the even earlier part of the funnel, if you will. Maybe just addressing the established managers. So we think about our program as what net new will be additive, what is complementary. It doesn't mean because we have certain allocations that they're fixed and no further ones can come through that area. I think I referenced fixed income relative value as an example. We have that in the systematic space as well. So depending on capacity, we may go with more managers or fewer. It just depends. But basically, anything net new into the portfolio will analyze from a portfolio construction impact. And we often think about both the qualitative and quantitative, such as correlations or volatility profile around that net new addition. So it's a constantly evolving program in which the direction of travel is increasing in terms of dollars allocated. So we're very active. We're continuing to build our program and to continue to allocate.
And then, again, a nod to the sort of sheer size of the portfolio in terms of, what size you like to be. How do you think about sizing, particularly in the established manager space?
We think about it as about roughly 300 million and above. We will have the initial immediate ticket that we'll invest, and then we'll also seek to negotiate the future capacity. Often that's easier, of course, with the emerging manager, but it can be sometimes with established. So we think about as those larger tickets for established and potentially the anchor investor for a new launch. And then we'll also, for the smaller Inicio type manager, it could be 50 million and within a range of 50 to 75 or 100. We also do co-invest, so that's roughly the range between Inicio and co-investment, more the agile, nimble dollar size,
Right.
in contrast to the larger investments that we'll make for established groups.
Well, I was going to ask you about the co-investment program because I think in recent years that's also got quite a lot of attention and sometimes can be the way that you build up a relationship with a new established manager. Is that, again, it's an area of focus?
Yes, definitely. It sits within our group as well. So we see all of these as working in concert and all centered around the manager. So we have been growing our co-investment efforts over the years steadily from 2018 until now. So we have,
It's across all segments?
Yes.
All
Yeah.
strategy segments?
It's effectively structured as fundamental trades and then macro or relative value type of trades. A lot of those ideas are coming through our existing managers, but we do occasionally work with what we call off-platform managers. So that can be, as you were saying, a way to get to know the group. We think the alignment with our existing partners is stronger, but we do have scope, of course, to access investment ideas where we have, economics, a compensation model that can also make sense with non-invested partners.
Okay. The other thing that I think would be quite interesting for our listeners is when things go wrong. And some of this, again, you've been investing, or CPP Investments have been investing in hedge funds for a long while. And through your career, you will have seen funds come and go through the portfolio. To your mind, how do things go wrong? And by go wrong, I mean when a manager exits a portfolio. How do things go wrong? Is it always performance-driven?
Yeah, interesting question. So mostly it's not so dramatic. It is performance-driven. As we know, performance is the lifeblood of a fund that will attract more assets. And to the degree that performance is not there, assets also start to leave or go out the door. And that often leads to sometimes a fund closure. So that's the most often where it goes wrong. It's that critical moment in time where a fund in year 1, 2 has to deliver performance as well as get the investor interest or to keep and grow the investors who are making up the fee allocation. Otherwise, of course, if the fees are going down, it's harder to keep critical talent or to maintain an infrastructure. So it's all connected, as we know, but that's most often what we will see. It takes a few years to recognize that, but once it happens, it's sometimes an inevitable outcome. And that's just the nature of our industry, isn't it? It's a creative destruction in terms of new launches and that close.
It's a different approach to saying that all of the managers need to perform all of the time. You will have some flex to say there are certain strategies, that's why you have the diversity, that certain strategies won't be performing to the same degree. And that's why you've got that diversity of different strategies in the portfolio. But when you measure that performance of a single manager against a peer group, that's what you're looking at, presumably.
Exactly. I think it's an important point to flesh out, which is we're a long-term oriented investor. We think of ourselves as partners. We are driving towards commercial outcomes. So it's not an indefinite approach in that sense. We are comparing fund managers to the peer group. We're trying to understand what's the driver. There are always reasons why the returns may be less attractive. So it's not to say that if returns are down, we're out. Absolutely not. We tend to err on the more patient side. But again, it's not indefinite. So we do a quarterly portfolio review where we look at all of our line items and we discuss this pretty actively. But in terms of decision making, tend to be a bit more longer ended.
Just picking up on the talent piece that you mentioned there, congratulations on your recent accolade as one of 100 most influential women in finance. Of course, we think you are one of the most influential people in finance, full stop. But no, very well done on that. But talent and diversity, I think these are things that have been discussed in the past. You've been a big supporter, particularly of minorities in hedge funds. What's your assessment on progress, though, to date?
Yeah, thanks so much, Kumar, as well. Yeah, it's slow. I think we see this more broadly in not just the financial services, but other industries as well. So it's an ongoing challenge and something that we all need to contribute to. But I think it's great to have aspects like emerging managers. And again, for us, it's not necessarily women in minorities program, but emerging managers more broadly. But I think we do tend to see some of the diversity coming up through that channel as well. So I think it's a really important area of focus. We do think about that a lot as an organization in terms of our own internal efforts through employee groups, support groups, as well as our external efforts around things like board diversity, our governance voting. So we tend to try to impact that in broad ways. And then through our hedge fund program, I think it's really through the emerging manager channel.
And just sort of then looking forward then, what are some of the things that you think are going to be front of mind for either yourselves or for hedge fund managers that you're looking to invest in?
I think having been in the industry for a long time, this is a constantly evolving space. So it's the new innovations, whether that's the managed accounts, different ways of trading, alpha capture, the combination of quant and fundamental, for example, new innovations, or even as you were talking about macro or policy changes that can result in new opportunities. So I think it's just continuous evolution and being alive to that as well.
And as a program, would you say is it revolution or evolution?
Definitely evolution. We started as a program at CPP Investments. The external portfolio management team started in 2004. I joined in 2012, and it's definitely been in a constant evolution in terms of refining, taking a very solid foundation, but trying to make it better and better year over year and moving with the opportunity side.
Well, given the amount of interest that certainly we hear about and feel from our client base and prospective client base, I think we're certainly in alignment with that. I think this has been very, very helpful. Thank you for being so candid. And we've covered a broad range of topics, but no, that was very helpful indeed.
Thank you so much, and thanks for the partnership with JP Morgan. Really grateful for that and look forward to working more together.
Thank you, Amy.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.
Copyright 2025 JP Morgan Chase & Company. All rights reserved.